Hello everyone. I hope everyone is doing good and listening me clearly. So please guys do let me know, are you guys listening me clearly? So please guys do let me know, are you guys listening me clearly? Okay, thank you so much everyone. Okay, thank you so much. Okay guys, this is day 2 of practice to pass session for June 2022. In yesterday's class, we covered question 1 of past exam, and the exam was March June 21. In today's class, we are going to solve question 1 from September December 2022 past exam. So we are going to solve question 1 and we are going to solve question 2 as well from September December 2022. So what actually this is 2021. So September December 2021 past exam. So this is the recent past paper that is available. We will be revising the topics that are going to help us to solve these question 1 and question 2. And what are these topics? Let's understand. The topic is, first we will understand associate, which is IS 28. Then we will be understanding the concept of de facto control under IFRS 10, which is control for less than 50%. If we have less than 50% voting rights, and with less than 50% voting rights, we have required control. So we often call this de facto control. So we will be revising the concept of de facto control, and then we will be applying this in this question 1. Then guys, we have to revise step acquisition, deferred tax on at the date of acquisition, IS 21, other comprehensive income items. For question 2, we have to revise ethics, IFRS 15, step 2 and 3, and then we will be talking about IS 38, development cost criteria and its application. So these are the topics that we are going to discuss in today's session. So if you are not added to the WhatsApp group yet, then you can text me. You can drop a WhatsApp at my number. I will share a link and you can join WhatsApp group through that thing. So this is my number. So please drop a WhatsApp at this number so that I can add you guys in the WhatsApp group. So yes, these sessions are being uploaded on ACCA YouTube channel, and I will share the link in the WhatsApp group. Okay. So you can cover yesterday's session from there. So guys, let's start. What we are going to do today so the first thing is September December 2021 question 1. So recent past paper that is available, and we have to solve this question, guys. So the first part of this question, along with requirement, is in front of you. So let's understand what is in the question, and then we will revise the topic, and then we will apply that topic to the question. Okay, guys, so just focus on the question. Then we will be talking about other stuff, like what other videos you have to watch along with these sessions. We will be talking about these stuff at the end of the session, okay? So just focus on the question right now. So guys, very important requirement. So what is requirement? Requirement is draft an explanatory note to the directors of C company to address the following issues. Why it was correct to initially classify grain company as an associate. So guys, the requirement is why it was correct to initially classify grain as an associate. So the examiner is asking why it is an associate company, why it is correct to classify a grain company as an associate. Now, second part is very important. As opposed to a subsidiary on 1st April 2002. So this is not the requirement that you are going to write about associate, why this company is associate, but the full requirement is that you have to write why this company is an associate. Then you have to discuss why this company is not a subsidiary. So if you are not writing this stuff, that why this company is not a subsidiary, then it means you will get only 2 marks. So total marks of this part is 4 marks. You have to prove why this is an associate, and you have to prove that why this is not a subsidiary. So majority students who attempted this question in past paper in their exams miss these 2 marks. They did write that why this company is an associate, but they didn't talk about subsidiary, why this is not a subsidiary. So please read the requirement carefully, divide the requirement into subparts. You have to divide the requirement into subparts, multiple parts. There are multiple requirements in one requirement. So there are 2 requirements. First thing that you need to understand is this. Now, we have to talk about what is associate. So I'm going to revise some of the top basic understanding of associate. Associate is a company over which you have significant influence, over which investor has significant influence. And we know significant influence means ability to participate in decisions. You have ability to participate in decisions of that investee, of that company. Here is the green company. So if you have ability to participate in operational and financial decisions, then it means the company is an associate. But for subsidiary, you must have a control. For subsidiary, you must have a control. And for control, as we were talking about controls definition in yesterday's session, that you must have power over investee. It means you are giving directions about all the relevant activities of the business. Then you must have exposure or rights to variable returns. Exposure or rights to variable returns. to variable returns. And then third thing is that you must have ability to use this part to affect these returns. So this is third point, that you must have ability to use the power to affect the variable returns. So if you are going to conclude that this company is an associate, you have to prove that we have significant influence over this company, and we don't have control. So if you are not mentioning that we don't have control, it means you are losing easy marks available in the exam, and you can't afford to lose these easy marks that are available in the exams. So this is the basic thing that you should have in your mind while answering this question. Then ability to participate in decision making, we have certain indications. Then we have certain indications, guys. What are those indications? That usually we have presentation in board of directors, but in minority. We have representation, we have our board members, we have our directors in that company, but obviously in minority. But in control situation, you have board of directors, and you have ability to appoint or remove majority board of directors. Then guys, other are that you are participating in policy making, you are just participating in decisions, you are taking decisions here. In control, in a subsidiary, you are taking decisions. Here usually percentage would be 20 to 50%, and here usually percentage would be 50%, but this is not always necessary. Usually we have voting rights above 50%. But the most important thing is, if you have ability to appoint majority board of directors, then it means you have control. If you have ability to appoint minority board of directors, then it means you have influence. Now let's move towards the question. This is the basic framework, basic knowledge that you should have in your mind while answering the question. And obviously you have to reproduce this information as well. Now let's apply this knowledge to the question. On 1st April 2002, C company acquired 30% of the equity shares of G company. So the percentage of holding is 30%. Although percentage is 30%, but it doesn't mean this can't be a. Okay, guys. Now the consideration consisted of 100 million cash. So the consideration paid is 100 million. We need this cost to calculate investment in associate. The carrying amount of the net assets of Green Company on 1st April 2002. The carrying amount of the net assets of Green Company on 1st April X2 were 286 million, which was the same as their fair value. So there is no fair value adjustments. It means the net assets are already at their fair values. So if there is a fair value adjustments, you need to make the fair value adjustments as well. Even in associates, you have to take net assets at fair value. If both carrying value and fair value would have been given, so I will choose fair value of net assets. Since then, Green Company has been correctly treated as an associate in the consolidated financial statements of C Company. The remaining 70%, this is going to be an important thing to answer the question. The remaining 70% of the equity of Green Company at 1st April X2 is owned by few other investors. So it is owned by few other investors. They are very few. In a while, we will be talking about de facto control. So this would be an important thing, that other investors are very few. None of which own more than 10% of the equity of Green Company. None of which own more than 10% of equity of Green Company. Analysis shows that all shareholders have voted independently in the past. So the other shareholders have more than 10% holding. It means they have significant holding. It means they have more than 10%. They are voting independently. They are voting independently in the past. C company and G company share some key management personnel. So they are exchanging some key management persons as well. So this is again an indication of an associate. Now, guys, because other investors are always vote independently in the past, so it means whenever there is a board meeting or whenever there is an AGM, annual general meeting, we have 30% holding, but the other owners have 10% holding. They always vote in the meeting. So we can't say that we are able to take decisions of this company independently. So you can't take decisions independently by having just 30%. So they can easily outvote you. They can easily outvote you. They can easily outcast you by voting against you. So you can't say that by having 30%, we are having control of this company. We don't have an ability to control in this situation. So we would say that because other stakeholders are significant stakeholders, they always vote. So we cannot say that out of 100%, by having 30%, we are controlling the company. So no control is there. So it would not be considered as subsidiary. So it's better to consider it as an associate. So this is the theoretical part that you need to solve, guys. Is that okay? Okay. Now, let me revise the topic, de facto control, and then we will come again here to understand whether we have control or not. Okay. So let's understand the concept of control. Even if we don't have 50%. So this is again a standard. So let me revise this concept, guys. Look, the first situation when you don't have 50% and still you have a control is that you have contract with other investors. So in my example, P company has 45%. P company has 45% shares in some company, and they made an agreement with other investor who has 6% holding. There was an investor, they have an agreement with that investor who has 6%. So they just made an agreement that we just want to control this company, please help us. So the 6% investor is helping you by an agreement that you are going to control the company. I will not interfere. I will vote wherever you will say. I will vote in favor of those directors you want to apply, you want to appoint. So I will vote against those directors you want to remove. So it means by this agreement with other investors, now you actually have 51% voting rights. Although you are 45% shareholder, you have actually 45% but just by agreement with other investors, now you have 51%. So you are controlling the company, you have ability to appoint, to remove majority board of directors. So we would say that in this situation, P company has control over subsidiary. And if you have control, then you have to say that the company is our subsidiary and you have to consolidate. You have to consolidate. So you need to consolidate. Obviously, the parent share would be 45%. And NCI share would be 55%. These 6% investors are part of NCI, although they are helping us to acquire control. But when we will divide profits, obviously NCI percentage would be 55%. So this is first point. Now, second point, potential shareholding or potential voting rights. So potential shareholding or potential voting rights. What is this? This is going to help us to solve the next part. So I'm just keeping this for the next part. I will explain in a while solving the next part. Then guys, third situation is that you have ability to appoint or remove majority board of directors. If somehow, maybe by a court order, the other investors who have majority, they were doing something wrong in the company, and we took a court order, and according to the court order, now we have the ability to appoint or remove majority board of directors. So maybe we have contractual arrangements, and according to those contractual arrangements, even though we have 30, 40, 50%, still we have ability to appoint or remove majority board of directors. Like a government wants to sell a company, there is a government company, and the government owned company, and government wants to sell this company, government wants to privatize this company. Now there is an investor who is willing to acquire this company, but only 25%. So is willing to acquire 25% holding in this company. So government is ready to sell, to offload 25% holding to that investor, but that investor has put a condition that government is not going to, even though government would have 75% after the disposal, but government is not going to control the company. It's the person who is going to control that company. So there is a contractual agreement at the time of buy that although government would have 75% after disposal, and the investor will have 25% holding. So we will say that because there is a contractual arrangement, so majority board of directors will be appointed by this investor rather than government. So according to us, the subsidiary, that this company would be a subsidiary of investor who has 25% holding. So this could be the situation, guys. The fourth situation is percentage of relevant holding, relative holding. What does it mean? If you are having a shares in a company around 44%, so we are having holding of 44%, our voting rights is 44%. But all other shareholders, which are actually 56%, all other shareholders, they have very less shareholding. Means they have less than 1%. It means they didn't invest a significant amount in the company. They have less than 1%. I'm talking about less than 1%. They are widely dispersed. Means someone is sitting in Turkey, someone is sitting in UK, someone is sitting in a country where it would not be possible for him to join AGM, to vote in the AGM, in the appointment of directors. So they are widely dispersed. So they are not going to attend AGM, they are not going to vote in AGM, as well as listen carefully. Someone can think that nowadays AGM can happen remotely, but if they are widely dispersed and they have very less holding, some investors would not be interested to vote. The first point, they would not be interested to vote. They will not be interested to vote. They will not vote. The second thing that is more important is that they cannot combine against you. They cannot combine, they cannot aggregate, they cannot make a force against you. This is something more important. Why we are saying that they are widely dispersed? It means they will not combine against you. They are widely dispersed. They don't know each other. So if they are widely dispersed, so it is highly likely that they will combine against you and they will outvote you in AGM. So this is something that is really important. So AGM attendance is very low. means AGM attendance is 70%. Look, so it means 44% is our representation, and other than this 44%, only 26% people attend the AGM. So they have very low holding. It means if they are very low shareholding, it means they are not interested in companies affair. Maybe they have invested to gain, to take the gains, to take the fair value fluctuation of the shares. Then they are widely dispersed. They are widely dispersed. They will not combine, aggregate against you. So the chances of their agreement is very low. And then AGM attendance is also low. 30% didn't vote in AGMs. It is the past history. So in these situations, we can say that although we have 44%, but in the AGMs, we can say that we are in majority, and we can say that we have control. So even if you have these types of this type of control, then you have to consolidate the subsidiary. And most important thing now is you will consolidate, but you will closely look, you will closely observe the situation, that is there any investor who is getting more shares. If two or three investors are getting more and more shares, and they are very close friends, they live in one country, they are very close friends, then it means they can easily combine against you. They can easily create a force against you to outcast you in AGM, to outvote you in AGM. So it means now you can say that because the holding is increasing actually the holding is concentrated in some hands. So we can say that now we actually, it seems that we have to lose the control. So this could be the situation, guys. I hope this point is clear to everyone. If you have any questions now, I'm open to questions, please. If you have any questions regarding these points. Okay. So someone asked me to repeat point 3. Someone has asked me to repeat point 2. Point 2, I didn't discuss point 2 yet. But point 3 is you have the ability to appoint or remove majority board of directors. We have a holding of just 30% in a company. The other investor is 70%, but they were doing something wrong in the company against us. We went to the court. We put a case against them. We sue them. And it has been observed that by this 30%, so now the court has ordered that they are really engaged in wrong activities in the company. So the court ordered that you have the ability to join the order. This is the point 3, guys. Now, someone has asked me that where is why this is 45%. This is not important, 45%, guys. So this is just an example. Contract with other investors means if you have 40% and the other investor who has 12%, you can have an agreement with them. It will make you both 52%, and you can say you are controlling. If you have 48% and you are having an agreement, you are going to have an agreement with an investor who has 12%, it will make you both 60%, above 50% you can control. So by agreement. So this is just an example that if a company has 45% and they have an agreement with 6% other investor that we are going to control the company and he's going to help you, so then it means you have a control. Okay. And if you are having a control, obviously when you will distribute profits, so because as a parent you have 45%, so you will have 45%, and NCI would be automatically 55%. In this situation, you are 40%, NCI would be 60%. In this situation, you are 48%, NCI would be 52%. And obviously, we would be the parent. If we are saying that we have having control with an agreement, by having an agreement with other investors, it means we are the parent. We are the parent, but we don't have more than 50% holding. This is de facto control. So control, even we have less than 50% shares. Is that okay? Yes. Okay. Now, guys, let's talk about step 4. What is step 4? Step 2.2. The point 2 is really important, and he has asked this point 2 in the next situation, next scenario. So listen carefully now. Sometimes you have less than 50%. You have less than 50%, but you have potential shareholding or potential voting rights. Potential voting rights means, guys, potential voting rights means potential shareholding means you have options, warrants in that company, you have convertible loan in that company. So options, convertible loans. At at this point of time, options, convertible loan are not shares. They are just a loan, but they have potential that they can give you a further shareholding in that company. So these are potential voting rights. Means we don't have these voting rights right now with us, but in future, sometimes in future, we will have to access, we can exercise these convertible loans, we can exercise these options, and we can control the company by acquiring more shares. Okay. Up now, I'm taking example. So just take an example that we have 45%. We have just 45% holding. Okay. So this could be 40%, this could be 35%, this could be 48%. So in my example, some company which is PE has 45% shareholding or voting rights. Okay. And along with these 45% holding, they have convertible loan, which can give them 10% more shares, which can give them 10% more shares. Right now, so right now we have 45%, but we can get more 10% by converting these loans, This loan can be converted into shares sometimes in future. Now, what is this? Listen carefully. So 45% convertible loan, right now you don't have ability to appoint majority directors, you don't have ability to take decisions. But as per IFRS 10, if these 3 points are there, these 3 points, then you can say that we right now we have control. Even though we have 45%, we can say that we have control. And control means it's a subsidiary. So we can prove that with 45%, we have a control. So is there any difference between de facto control or control? No, there is no difference. Control is a control. Either it's a de facto or it's a control, simple. So de facto control means less than 50%, but still we have a control. This is called de facto control. But actually it's a control, okay? Control means subsidiary, and you have to do the consolidation of a subsidiary. You have to consolidate the subsidiary as per IFRS 3. So guys, 45%, what are these 3 points? If convertible loan is currently exercisable, means right now, if you want to exercise, you have ability to exercise. It means right now, it is right now, this company can exercise these convertible loans. They can exercise this convertible loan, they can get extra 10%, and then they will start controlling the company. So favorable to exercise means when we have convertible loan, we have 2 options. The first option is that we can get our cash back. We can call our cash back. We can ask for cash, that return our cash. So the first option is cash. And the other option is that you can convert into shares. So always loan provider the convertible loan holder will choose between cash and shares on the basis of which one is beneficial, on the basis of benefits. Like if the cash is, we can get cash of 10K dollars, which is 10,000, and we can have a shares of 15K worth. So the market value of shares which can be taken, which can be acquired at the time of conversion is of 15K, and the cash is only 10K. So what we are going to do, guys, if you have two options, you can get shares which has a market value of 15K, 15,000, and on the other hand, you have option that you can take cash of 10,000. What are you going to do? Obviously, shares. This is called favorable to exercise. So currently exercisable, favorable to exercise, and the third one is ability to exercise. Ability to exercise means you have ability after conversion, you will keep these shares with you. You don't need a cash immediately. If you need a cash immediately, you will sell these shares. You are not going to keep these shares. So they are saying if you are going to acquire, they are saying that if you are going to acquire these shares, then you will keep these shares. It means you have ability to exercise and keep these shares. So if these 3 points are there, we will say right now, we will say without exercising convertible loan, we will say we have a control over this company. Even though we have 45%, now the we have, along with our convertible loan, we will say that we have control over this company if these 3 points are there. Okay. Now, this 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 thing can be said in the money. We use different words for the options. If option is favorable, we will say this is in the money options. If this is unfavorable to exercise, means the shares have a market value of share is only $5,000 and the cash would be 10,000. So we would say that this is unfavorable for us. We shouldn't take shares. So in that situation, that would be an out of money. So they are saying that option should be in the money, favorable. Now, right now, guys, we are having a control. Now, listen carefully. What I'm going to say. This is really important. Now, although we have 45%, but still this convertible loan help us to gain control of the company. Before exercising, this is important, before exercising, right now, we will be consolidating that company. So the consolidation will be done at 45%, guys. We will consolidate because we are going to control. Even someone is taking decisions, someone else is taking decisions of this company. Someone else is taking decisions of this company. So even then, we are not taking decisions. Even then, we will be saying that this is our subsidiary, because the control is not something that we exercise all the time. Control is something that we can exercise anytime. What does it mean? It means if someone is controlling the company, we have ability to remove him or her anytime. What does it mean? We have 45%, we can convert 10% anytime, because all the things, all the conditions are in our favor. So we can exercise at any time and we can remove that person anytime. It means we have ability to remove the decision maker. We have ability to appoint new decision makers. So we will say from today that we have a control, although we don't have more than 50%. So this is how convertible loans, potential shares, could help you to acquire control. Now, let's apply these concepts in the question, then we will come again back to this point again by discussion. Someone asked me what is currently exercisable means. Look, if today is 29th May 2021. If it is written on the convertible loan that it can be exercised on 31st December of 2021. Now you can convert this into shares, but on 31st December 2021. So it means currently at this date, this option, these convertible loans are not currently exercisable. They will become exercisable on December X1. So right now we don't have any control over that company. But on 31st December 2021, 31st December 2021, we will say that this company is our subsidiary if these conditions, these other two conditions are there. Okay, guys. Now let's move towards, we have observed that the company does not control the Chuckle company, the C company is not controlling the Green company here. They are just having a significant influence. We talked about this. So none of which own more than 10%. This is none of own 10%. Okay, still we can say they regularly vote in the meeting. So we can say that the AGM attendance, we need to observe the AGM attendance, and by just having 30%, we can't say that right now we have a control. Now, guys, let's move towards this part. This is going to be an interesting part. Listen carefully. What is this part now? So the question is, the first part is, how Green company should be counted for as an associate using equity method in the consolidated statement of financial position of C company at 31st March X6. So they are asking you to give your answer should also explain how the revaluation of the land on 1st April X5 was accounted for and include all relevant calculations. So guys, there are again two requirements. Always divide requirements into multiple requirements. Always do that if you want to pick the easy marks. Okay. So now I need to divide this. So the first part is how Green should be accounted for as an associate. So it means I need to give explanation. So I have to give explanation. So whatever I'm doing, I have to explain. What is this explanation? I'm going to repeat in a while. So you need to give an explanation how you are applying equity method. Equity method is the method that is applied to the associates in the consolidated statement of financial position of C company at 31st March X6. Your answer should also explain the revaluation of land. The second requirement is explain how the revaluation of land on 1st April X5 was accounted. So you need to explain this revaluation of land as well for exhibit 2 and include all, this is exhibit 2, and include all relevant calculations. So the third requirement is that you have to give calculation as well. So these are the three requirements. So you have to address these three requirements. You have to write something about these requirements. Only 5 marks are there. So if you multiply this one with 1.8 or 1.95, you will see that you have to solve this question in 8 to 9 minutes. Now, keeping in mind the time, you have to talk about all these stuff. You can summarize this explanation. You can summarize the calculations. You can write in one line. You can summarize this, but this is not the right approach that you just write about one thing, you just write about two things. You have to cover all the points. Okay. So first thing is always divide your requirement into sub requirements, into sub parts. And now you have to cover this. So let's talk about these things, and we will be talking about it. Listen carefully now. Okay, guys. So how to deal associate? We need to revise. So this is investment in associate carrying value. We write investment in associate under equity method. Initially we write them at cost. So initially we write them at cost. Then we pick share of profit, post acquisition profits and OCI. Profits means retained earnings. We pick associate share of retained earnings. And then we pick other comprehensive income. Other comprehensive income means other reserves. You can say other components of equity, other reserves. We usually call it other components of equity. So you need to pick the share of profits and you need to pick the share of OCI. So this is something that you need to explain, that we are going to apply an equity method on investment in associate, and we will write this at cost. Initially, we'll write this at cost. We will initially carry this, we'll record this, recognize this at cost, and then we will add share of post acquisition profits and OCI. And if there is any impairment loss, we need to deduct. If there is any bargain purchase gain, we need to add. If there is any unrealized profit, if investor is a seller, we need to deduct. If there is any dividend, we need to deduct. Now, guys, in this question, these things are not there. These things are not mentioned in the question. So if these things are not mentioned in the question, so these should not be in your discussion as well. So it is not necessary to write each and everything you know about associate. Okay. So in this question, this was not there. So I will not talk about this. This was not there. I will not talk about this. So these things were not there. So we will not talk about these things. So we should talk about those things which actually exist in the question. Okay. Now, in income statement, we will write this in as a single line item on the face of statement of comprehensive income. As a single line item means we will write on the face of income statement, and we will write share of profit from associate. In the same way, in P&L, and in the same way, we will be writing a share of OCI as a single line item. Now, this thing is going to be very important, and usually students don't know this thing, don't remember this thing. So, single line item. So just focus on this. What is BPG? It is bargain purchase gain. It is bargain purchase gain. Just like goodwill, it is the negative goodwill. Okay. But right now, our focus is not on impairment loss, not on bargain purchase gain, not on unrealized profit. We are actually talking about the share of OCI. So it should be shown as a single line item in OCI. So now I'm going to talk about the point that is very important and has been tested here. So what is this point right now? Listen carefully. Okay. In a while, we will be solving a question in which we will talk about that in other comprehensive income, we have two items. Some items will be reclassified to P&L. I will talk about this area in detail in a while, along with next question. But there are certain things that will be reclassified to P&L. Right now, you are going to write them in OCI, other comprehensive income, other comprehensive income. You are writing them in other comprehensive income, other comprehensive income, other. But at some point, you have to recycle this towards P&L. You have to recycle this towards P&L. You have to reclassify to P&L. And there are certain things that will not be recycled, not reclassified, not recycled to P&L. Not reclassified to P&L. So the revaluation gain is an example. Revaluation gain is an example of an item that usually we show in other comprehensive income. As per IAS 16, obviously, if there is a loss, gain will charge to P&L, but the gain that has been charged to other comprehensive income is an item that will not be reclassified to P&L. Rather, it will be transferred from revaluation reserve to retained earning. So what we will be doing at the time of sale or over the life, what we will be doing, we will be deducting some amount from revaluation reserve, means we are transferring revaluation reserve towards retained earning within statement of changes in equity. We will not take back this revaluation gain towards P&L. It will be recycled, it will not be recycled, it will be only transferred within statement of changes in equity. It will be, and there are certain items which will be recycled to P&L. So this is something important, that in other comprehensive income, we have two items, okay? I'm going to talk about this in detail. Look, this is something that we will be talking about in the next question. So I'm just taking a point that is relevant to the question. Otherwise, we will be talking about these things. Look, there are certain items that will be recycled and there are certain items that will not be recycled. So we'll revise all the areas. But right now, revaluation gain is in the question and that will not be recycled. And what is the point right now? This is really important. So what we are going to do in an investment in associate, we will write the investment in associate at cost. Very first day, we will write it at cost. And then what we are going to do, we will add share of post-tax profits and OCI. And we will write in the cost and we will write in this in P&L and OCI. So the point, most important point is, if there is a disposal of associate, if we have disposed the associate, if there is a disposal of associate, if there is a disposal of associate, guys. Now what you need to do, obviously you will de-recognize the associate, you will book profit loss in P&L. You need to de-recognize. So you will de-recognize associate. You will de-recognize associate. Means you will book the profit or loss in P&L. And the most important line is, anything written in OCI, this is important, anything previously written in OCI will be either transferred within statement of changes in equity or will be recycled, reclassified to P&L depending on the nature of that item. So this is something that is new, maybe new to your knowledge. So this is something important, and usually people don't remember this point. So please listen carefully. So let me put an example and then we will do that. Okay. Suppose I have invested, I'm taking an example that we have invested 200 in an associate. So my investment is 200. That company earned a profit. Associate profit is given in the question. So if that company's associate profit after tax is 220, we have acquired 30% shares in that company, and this is our associate. In other comprehensive income of that company, there are two items. One is that will be recycled to P&L. That will be recycled to P&L. There are two items here. One is recycled to P&L. Suppose that amount is 10. And there is another amount that is revaluation gain. And we just talk about this revaluation gain, that this amount will not be recycled, not reclassified to P&L. Okay. So this amount is, just assume this is 30. Now what we need to do? In cost, we need to add all these points. So we'll pick 20 into 30%. We'll take 30% share of this 20. It will give me 6. We'll take 30% of 10. It will give me 3. And we will take 30% of this 30 as well. So it will give me exactly 9. So I'm going to write this 6, 3, and 9. And now my investment value is, my carrying value of investment would be 218. Now, if we have sold this investment, if we have disposed this investment, now we need to de-recognize this investment. What will happen with these amounts, guys? What will happen with these amounts? This is my question. Please write an answer in the chat box. I just want your answer. What will happen with this 3? With this 3, and what will happen with this 9. So this is my question actually. What will happen? So if you are disposing an associate, what will happen with this amount, guys? So waiting, guys. Yes, Crystal is Muna, Crystal, and Ambika. Everyone is right. Okay. So guys, yes, you are right. What we are going to do, we will this amount will be transferred to retained earnings, because originally the treatment of this 9 is, this is revaluation gain, and this will be transferred to retained earning at the date of disposal. So it will be transferred to retained earnings, and this three amount will be recycled to P&L. So this is what you need to do other than disposal, recycle to P&L. So OCI items further treatment at the time of disposal will depend whether those items are items that can be reclassified to P&L, recycled to P&L, or those items are can't be recycled to P&L. So you need to observe this. Okay, someone is saying, how did you get 3? Okay, look, this is associates statement of comprehensive income. The company, which is my associate, that company earned 20 profit after tax, that company earned 10, an item that can be recycled to P&L, and that item earned 30 of revaluation gain. So I have to pick profit after tax 30%. We have to pick items that can be recycled to P&L 30%. We have to pick revaluation gain 30%. So these are the items that we will pick, and obviously we need to recycle this. So what is the profit on disposal? Someone is asking me, what is the profit on disposal? That actually depends. Okay, how you have disposed this associate. Just take an example. Just make it to make it further clear. Just assume that we sold this shareholding. We sold all shareholding in associate. We sold all shareholding in associate for, give me value, guys, or shareholding for dollar G. So you can say we have sold this for 250. For 250, thank you. Okay, now if you have sold this for 250, now what you need to do is you will debit cash. You are going to record cash of 250, and the carrying value of associate is 218. This is profit on disposal, guys, because we sold for 250 and the carrying value is just 18. So the profit is 32, and it will be charged to P&L. It will be charged to P&L, but other than this P&L, we need to do these two extra treatments, that we need to transfer this to retained earnings, and we have to recycle this to P&L. Am I clear, everyone? Is that okay? Yes. Yes, yes, yes. Yes. This 332 will be charged to P&L. This 32 will be charged to P&L. This 3 will also be recycled to P&L. This will be transferred to retained earnings. I hope everyone is clear now. Because that is a revaluation gain, and revaluation gain cannot be recycled to P&L. Mr. Manzoor? Okay, guys. Now, let's go back to the question and just calculate. You need to explain these things, guys. And now just calculate investment in associate. Now you have to calculate investment in associate. So guys, what is the cost of this investment? We have already calculated cost 100 million. Look, 100 million is the cost, and net assets at that time was 286. Okay, 286. Remember 286. Now guys, so what we should do, we should be doing, listen carefully. So guys, what is my cost? What is my cost? My cost is cost of associate 100. Now I need to pick share of post profits, share of post profits. So listen carefully. C company acquired a further 18% of Green company's equity on 1st April 2006. The consideration for a further 18% of the equity shares of Green company on 1st April 6 was 66 million in cash. The fair value of original 30% equity interest was 127 on 1st April 6. The carrying amount of net assets of Green on 1st April 6 was 348, which included some land, which had been revalued upward by 15 million and correctly accounted for on 1st April 2005. So most important thing is, guys, 348 are the net assets. So what was the net assets at the date of acquisition, guys? What were the net assets at acquisition date? In the previous exhibit, 246 or 286? I think it was 246 or 286, guys. Okay. 246. Come on, guys. Okay, it is 286, guys. This is 286. 286. Okay. 286. Now what we need to do is, so it has an item, guys, revaluation gain, revaluation upward of 15 million, and it has correctly been accounted for. It means this is an OCI item. So what we need to do is, we need to pick share of post-tax profits and other components of equity. Right now, this is 348. At acquisition of associate, it was 286, and we need to pick 30% of our share. So what would be the share of post-tax profits, guys? Please tell me what would be the share of post-tax profits. 348 are the net assets now. At the time of acquisition of associate, it was 286. So our share is 18.6. Look. Now they are saying deferred tax of 20% had also been correctly accounted for on this gain in individual statement of financial position of G company at 31st March X6. The rest of the increase in the net assets of G company since acquisition was solely due to profits. So the post acquisitions are profit. It has only one item of OCI, which is revaluation gain. G company paid no dividends during the year, so no dividends paid, no accounting. So what we need to do is, we need to just understand that the value is 118.6, but this 118.6 has revaluation gain. It has revaluation gain. It has revaluation gain of 15, but it has 20% tax on it. So it means we have 80% of this amount. We have 80% of this amount. Now 15 into 80%, it has revaluation gain of 15. 80%, which will give you 12. It has revaluation gain of 12, and we just pick 30% of 12. So it means it has a revaluation gain of 12 into 30%. This will give me, I guess, 3.6. So remember this point, guys, that in revaluation gain, in revaluation, we have this 3.8. in our investment in associate, we have a revaluation gain of 3.6. And if we need to de-recognize this investment, if we have sold this investment, then this amount will be transferred to retained earnings. This amount will be transferred to retained earnings. Yes, this 15 is included in this amount. This 2, the tax of 3. If you see 15 into 20%, the tax is also included there. They have written that, look, which is included some land, and the deferred tax of 12% has also been correctly accounted for. Is that okay, everyone? Okay, now what we need to do is, now let's see what is the next question. So I have explained this. We have talked about the revaluation gain. We have talked about that the revaluation gain after deferred tax is 12. We pick our share of 30% as an investment in associate. We have write this as 3.6, and we will transfer this amount towards retained earning at disposal date. Is that okay? Now, guys, so this was the part. Now, what we need to do is, okay, remember, if you check okay, someone asked me, why did we apply 80% to the 15, guys? Why did we apply 80%? Because 20% was tax on this gain. So if gain was 15, there was a 20% tax on this, which was 3. So the tax after gain would be 12. That's why we need to make it net of tax. Is that okay? Okay, thank you so much. Now, guys, what we need to do, now, what is second requirement? Second requirement is whether the classification of C company investment in green company should change on 1st April X6. So what happened on 1st April X6? And they are asking whether the classification of C's investment in green company should change on 1st April X6. So they are asking this. What is its classification right now? What is the classification of investment in green right now? This company till 1st April X6 was an associate company. It was an associate company. So it was an associate company. Now, let's understand what happened on 1st April 2006. Look, we have already 30% in that company. And what is the line here? They are saying that we have further acquired, C company acquired a further 18% in green company. So guys, we have acquired a further 18% in that company. So we have acquired further 18% in that company. So this is the situation, guys. So what to do now? Listen carefully. So we still have 48%. What do you think, guys? Do we have control at 48%? We have 30% shareholding previously. Now we have acquired another 18%, and the percentage of holding is 48%. So do we have control over green company or not? So till now there is no control. Okay, till now, if this is the information that we have 30% and we have acquired another 18%, so till now there is no control, but we need to understand what are the other information available. But till now, at 48%, we usually don't have control. Okay, we usually, but let's understand what is written here again. Sir, the remaining 52% of the equity of Green Company at 1st April X6 is owned by few other investors. Sir, they are few. What does it mean? Why this is important that they are few? Why this is important that they are few? None of which own more than 10% of the equity of Green, although they don't own more than 10%, but they are very few. Why this is important that they are very few? They are not connected to each other. It means they are widely dispersed. Okay. Few other investors. Okay. But few other investors means they are widely dispersed, or they can combine against you. If they are few, they can combine against you or not. They can. Remember this word. Okay. Now, on 1st April 2006, C company also acquired some share options. C company also acquired some share options in Green Company. This is really an important. So the question actually suggesting us to apply potential shareholding. So they are acquiring certain share options in Green Company, exercisable anytime. What does it mean, exercisable at any time? Can we exercise it now? Why is it important that it can be exercisable anytime? Can purchase now? Because there was a criteria. There was a criteria. It can, if it can be exercised right now, then it can help you to acquire control. Otherwise, they can't help you to acquire control. Okay, thank you so much. Until 31st March X7, the exercise price of the option, this is important, the exercise price of the option on 1st April X6 was just above the market price of Green's share. Green Company has been profitable for a number of years, and the share price has been on an upward trend, which is expected to continue. This is important, guys. At 1st April 2000, the exercise price of option was just above the market value, market price, just above the market price. Means if the price is $50, so they are offering us at $51, just above the exercise price, means the price at which you can buy share under options through the options. But they are saying that the upward trend, and it is expected to continue upward. It means in some times the market value will increase and our exercise price will be less. So is this option is profitable? Do you think that this through this option we can buy shares a little cheap? Yes, profitable. So it means this is again a cheap thing. So we can say that it is beneficial for the company. It is beneficial to exercise. Right now on 1st April, you can say no. C company would increase its ownership to 60% should it exercise its rights. So they are saying that they wants to do this, and it will help them to acquire another 12%. The total holding after the exercise will become 60%. Bilkul. Yes, Mona, we can say that we have to pay a little higher for the premium. We can say that, but in sometimes that thing would not be a part of premium. Now, if you just wait for some months, obviously you can say that we can buy at a cheap price. So guys, it is believed that there would be additional cost saving should the additional shares be acquired, as decisions at board level could be made more efficiently. So they are saying that we can acquire further shares at a cost saving. Additional shares could be acquired if the board is making some decisions. They can be acquired with some cost saving. It means the options are in the money. So we can say that what we need to do is we can say that right now we have this investment, we can classify this investment as a subsidiary. What do you think, guys? Can we classify this as a subsidiary? Potential control, but this is control. But remember, this is control. Okay, this is de facto control. We can say na, it is a de facto control. We can say this is de facto control, but actually de facto control is a control. Yes, because control can be exercised at any time. Very well said. So yes, control can be exercised at any time. It means yes, we have a control, and even control is control. Even at less than 50%, control is a control. It's just a name, de facto control. Otherwise, control is a control. So thank you. Okay, now what we need to do is we need to, okay, very important point. Someone is saying that if the exercise price is higher than the market price, then don't exercise. Yes, and then we will say that there is no control over subsidiary right now. We can say that there is no control right now. Is that okay? But the first time you need to decide whether it's a subsidiary is year end. It will become guys, at year end, obviously it will become deep in the money. Okay. So now we are moving towards the last part of this question. And what is this last part of the question? Listen carefully. But for this part of the question, we need to understand two things. The first thing that we need to understand is step acquisition. So we will revise step acquisition, and then we need to understand, we need to revise the deferred taxation at the date of acquisition. So what we are going to do right now, listen carefully. So we need to revise two concepts, guys, deferred taxation as well as piecemeal acquisition. So right now, the important thing is deferred taxation. I hope everyone is aware about piecemeal acquisition, but we will revise the concepts of piecemeal acquisition quickly. So guys, listen carefully now. No, Bilal, actually, we don't have time for break. So we will not have any break. Okay, we need to wind this up on time. So I can't extend this for further 5 to 10 minutes. So I need to. So there would be no break, boy. So listen carefully right now. So deferred taxation consolidation aspects. So deferred taxation consolidation aspects. We all know that deferred tax arises on temporary differences. So whenever there is a temporary difference, whenever there is a temporary difference, we will say that there is a deferred tax. Whenever there is a temporary difference, we will say we need to apply a deferred tax. Now, what is temporary difference? Temporary difference is a difference between carrying value and tax base. So it's a difference between carrying value of asset or liability, means the value in accounting. So it's a difference between carrying value of asset and liability and tax base of asset and liability. Tax base of asset and liability. On the other hand, we have carrying value of asset or liability. So if there is any difference between carrying value of asset and liability, in text base of asset and liability, we will say there is a temporary difference, and every temporary difference will create deferred tax, except, but there is an exception of two items. The one is goodwill. Yes, we will not apply any deferred taxation on goodwill. But other than goodwill, in consolidation, we need to book deferred taxation on each and every item. Okay. Further, let's understand what we are going to do. As we know that we have individual books, we have parents individual books, we have subsidiary individual books, and we combine them, we consolidate them, we make consolidation adjustments, we combine them, and we make consolidated adjustments, and we make consolidated accounts. So we make consolidated accounts. So listen carefully, guys, now. So in individual companies, tax rules will always be applicable on individual companies. So tax rules are applicable on individual companies because the legal status of parent and subsidiary is that they cannot be considered as one. This is the legal status. Under the law, parent is a separate entity, subsidiary is a separate entity. They can't be one entity under the law. It's our concept substance over form, which says that if parent is controlling subsidiary, they are both one. We are doing consolidation just on the basis of substance over form. Legally, they are separate. And the text is a law again. So under the text law, parent will pay its own tax, subsidiary will pay its own tax, and they don't have a status as a single entity. So it means if parent is earning something from subsidiary, tax, as per tax law, parent has to pay tax. If subsidiary is earning something from parent, as per law, subsidiary has to pay tax. So because the rules, tax laws are applicable on individual books, because tax rules are applicable on individual books, so tax base will always be calculated from individual books. Tax base will be calculated from individual books. This is important. Tax base will be calculated from individual books. Why? Because tax base is a value of asset or liability under tax rules, and the tax rules are applicable on individual books. They are not applicable to consolidated books. So tax base, value of asset or liability, is under tax rules. So we will calculate tax base from individual books. So the first important point that I want everyone to remember is that tax base will be from in the individual books. Okay. But now we are dealing with consolidation. I'm talking about the deferred tax in consolidation. It means accountant is here. We are preparing accounts of consolidation. So carrying value is the value under accounting rules. So carrying value will be calculated from here. So guys, tax base will be calculated from individual books. Tax base will be calculated from individual books, and carrying value will be calculated from consolidated books. So this is something that is really important, and you need to understand this concept before going into further details. So what we need to do? Okay. Now listen carefully, guys. If we make any adjustment during consolidation, so you are making adjustment in consolidation, it will affect your carrying value, but it will not affect your tax base. It will not affect your tax base. The tax base will remain same because you are making adjustment in consolidation. So every consolidation adjustment, guys, every consolidation adjustment will create a difference between carrying value and tax base. Because you are making adjustment here, it will change the carrying value, but the tax base will remain same because tax base will be calculated from individual books. So no deferred taxation. So there would be a temporary difference in consolidation. So we need to book a deferred tax. So any adjustment, guys, what does it mean, sir? Any adjustments like fair value adjustments, like unrealized profits, so any adjustment. So if you are just adjusting the assets and liabilities, if you are adjusting assets and liabilities, if you are increasing some assets, you are decreasing some assets, you are increasing some liabilities, you are decreasing some liabilities, then it means it will increase your carrying value. So let's understand. If the first adjustment is fair value adjustments, if fair value increase, so it means parent in individual books, listen carefully, parent in individual books has the value of land, has a value of land 30. Okay, so value here is 30. Subsidiary value is 20. So both have land and their values are 30 and 20. So what we are going to do, we will combine them 30 plus 20. And we came to know that subsidiary fair value of land should be increased by 10, by 5, whatever is the value. So I'm just assuming these values, guys. So it will, what it will do, it will give you 55. So look, carrying value is 55, or you can say 25 of subsidiary, and the tax base is 20. So there is a difference of 5. If you can, if you want to do it in total, this is 50 and this is 55. Obviously, there is a difference of 5. So subsidiaries land, which was written at 20 in individual books, is now, we are saying that it should be written at 25. So it means there is a gain. So we have booked a gain, guys. So what does it make? What is the impact of this 5 gain on carrying value? So carrying value has increased. In my example, carrying value is 25, tax base from individual books, which is 20. So look, if carrying value of asset, is more than tax base, it will create taxable temporary difference. So fair value adjustment upward, gains, if you are booking gains, any gain, then it will create a deferred tax. It will be a taxable temporary difference. And we know that taxable temporary difference will create a deferred tax liability. It will create a deferred tax liability. And if fair value is decreasing, obviously it will be a deductible temporary difference, and deductible temporary difference will, what deductible temporary difference will do, it will be a deferred tax asset. It will be a deferred tax asset. So guys, this is important stuff. And I believe now onwards, I believe that this tax adjustment would always be there in consolidation questions, because examiner has started to test taxation on consolidation. So it will always be there somehow, maybe one adjustment, maybe more than one adjustments, but it would be there in all consolidation questions. So guys, if there is any fair value adjustment in consolidation, it will create taxable temporary difference. The gains will create taxable temporary differences. The losses will create deductible temporary difference. Okay. The second aspect is unrealized profits. Unrealized profits. So we know that unrealized profit, what would be the journal entry? You are going to debit profit and you are going to credit inventory. So what we do in consolidation, we say that we need to decrease inventory. So it means in consolidation, we are decreasing our asset. So if we are decreasing our asset, it means the carrying value of asset will decrease. And if carrying value is decreasing from the tax base, it will create a deductible temporary difference. So it will create deductible temporary difference, and we have to book a deferred tax asset. But in this deferred tax asset, we need to apply the buyer company tax rate. What does it mean? If parent is selling to subsidiary, the tax rate of subsidiary will be used. If subsidiary is selling to a parent, then the tax rate of parent will be used to calculate deferred tax asset. On the other hand, you can say that in consolidation, look, there is another way to explain these things. Please listen carefully. This is the correct way to explain these things, okay? But the understandable way is, look, let's talk about unrealized profit. The parent sold goods to subsidiary and earned a profit of rupees 10. This is unrealized profit in consolidation, but in the individual books, parent has to write this profit. So parent has recognized this unrealized profit in individual books. Now we know that the tax authorities apply tax on the basis of individual books. So tax authorities, tax law, tax department will ask parent to pay tax on this profit. They will ask parent to pay profit. They will say, parent, you have earned profit, so pay us a tax. Just assume tax rate is 30%, so parent has to pay a tax of 3. Although parent will say that I have earned from a subsidiary, so the tax law, tax department will say that you, parent and subsidiary, are separate entities. So if you have earned from subsidiary, in our books, in our calculations, in our law, as per tax, you have earned the profit. So the profit has been earned in individual books and it has been taxed. So this is important that we have already paid tax on this. Okay. So if we have paid tax on this, what should be the next thing? Now we need to consolidate, guys. What we are going to do in consolidation, we will say, no, this is not a profit. What will say? No, this is not a profit. So we will say, no, this is not profit. We will say there is no profit. So we need to eliminate this profit. We need to eliminate this profit in consolidation. This is not profit. So we need to eliminate profit. But the point is, in parent tax, this tax of unrealized profit is already there because parent has already paid the tax on this profit. When you will combine both companies tax, parent and subsidiary tax, and you will take it in consolidation, so tax of this profit will always be a part of this tax because you combine parent tax with subsidiary tax and it will give you tax, combined tax, consolidated tax. So in this consolidation tax, there is a tax of this profit, and we are in consolidation, we are eliminating this profit. So we have to eliminate this tax as well. So we have to eliminate. And this is how the deferred tax actually arises. That in the consolidated books, we are saying that this is not a profit of current year. It will be booked in next year's when the goods will be sold to third party. So this tax, which has already been paid, cannot be recognized right now. So we need to defer it. We need to defer it. So how you are going to defer it? Obviously by booking a deferred tax asset, and you'll defer tax when you will book deferred tax asset. On the other hand, on as a corresponding entry, the entry would be tax income. The entry would be tax income. So deferred tax asset to tax income. So this is what we need to do. And obviously, when we'll book income, so this will decrease this tax. I hope everyone is clear for unrealized profit as well. And maybe you see that there is a taxation impact on unrealized profit in your upcoming attempt. Is that okay, guys? Okay. So what is next now? So guys, let's understand what we need to do. So let's see what is in the question, guys. Now we need to adjust okay guys. So what is next now? So the carrying value of net assets of green company on 1st April X6 was as follows. We need to calculate net assets. So the first requirement is on the assumption that C company obtains control on 1st April X6, they are saying that assume that C company has acquired control of green company on 1st April. Explain how the fair value of non-current and current assets at acquisition, including any deferred tax adjustment, should be calculated. So 8 marks are there. We need to calculate and we need to explain as well. And then we need to calculate the goodwill for 8 marks. So 16 marks are for this part. So comparatively easy part. So let's understand what to do. Okay, guys, we have net assets of 348. We have net assets of 348. So what we are going to do, I'm going to calculate net assets at acquisition. And we have net assets total as per question, total net assets, carrying value. This is carrying value. We need to make fair value adjustments. So this is 348, guys. Look. So what to do now? Guys, are you listening me clearly? Please do let me know. Okay, thank you so much. So what is next now? Included within non-current assets was the land which had been previously revalued upward by 15 million. Exhibit 2, the same land which was previously revalued by 15 million on 1st April X5. The carrying amount of this land on 1st April X5 and 2000 X6 was 50 million. But the carrying value was 50 million, guys. But the fair value was assessed to be 60 million at 1st April X6. So if the carrying value of land, there is no depreciation requirement on land. So if the carrying value of land is 50 on 1st April X6, date of acquisition, so what would be the fair value adjustment? So if the fair value is 60, so what is the fair value adjustment? So guys, we need fair value adjustment of 10. Fair value adjustment land. Fair value adjustment land. So we have a gain of 10. But every gain will create a deferred tax. So you need to book a tax expense or you need to book a deferred tax liability. So deferred tax. So gain will create a deferred tax, guys. So we need to apply tax 10 is the gain, and the tax rate is some rate is given here 20%. So tax rate would be 20%, so it will be a 2. Okay. Then guys, current assets include finished goods with the cost of 84 million. Guys, the finished goods cost 84 million. We have to recognize in consolidation at fair value. We need to recognize this at fair value. The fair value of these goods is 131 million. So the fair value is again given. So fair value adjustment on inventory, we need fair value adjustment on inventory. So please give me what is the fair value adjustment on inventory. What is the fair value adjustment of inventory? Please give me the value. Sir, 84 is the cost of that asset, but inventory at acquisition should be recognized at fair value. So what would be the fair value adjustment? Okay. So what is the value, guys? 47? So 47 is the gain. So there is a fair value adjustment. There is a gain we need to add in the net assets. Now we need to apply the tax as well. So tax rate is 20%. So apply tax on this 47. It will give you 9.4. So is it 9.4, guys? Okay, guys. What is next now? Okay, guys. Next is on 1st April X6, the directors of CE company also identified that Green company had an internally generated database of customers who were likely to be interested in purchasing their products. Although there were no contractual or legal rights associated with this database, a professional expert has estimated that the competitors of Green company would be prepared to pay 5 million for this database. Green company has not recognized the database as an asset within their individual financial statements. Yes, they cannot recognize internally generated databases as an intangible asset, but in consolidation, we can recognize this as an intangible asset. But in consolidation, we can recognize this as an intangible asset because someone is ready to pay for this database of 5 million. So it means it has a value of 5 million. So we need to book a gain of 5 million. So I'm going to book again a fair value adjustment of database, fair value of database. We are going to recognize it. And the amount of database is, what is the value, guys? 5. So we need to book a 5. Obviously, we need to book a tax as well, 20%. So the 20% tax would be 1. So we have net assets, guys, and we need to explain this as well. Please, you need to explain, otherwise there would be a problem. So 348 plus 10 minus 2, 47, 9.451. So it will give me exactly 397.6. These are the net assets available at the date of acquisition. So these are the fair value of net assets at acquisition. So now, guys, what is next now? We need to understand this. So what is next now? So this is 394.6. Now the next part is you need to calculate goodwill. For goodwill calculation, you need to understand piecemeal acquisition. Someone asked me, why apply a tax on inventory? Yes, Akash, you are right. So we just talked about this. Look, if there is any fair value adjustment at acquisition date or after acquisition date, and there is an increase in fair value, so you have to book, it will be a taxable temporary difference. You have to book a taxable, you have to book a deferred tax, irrespective whether it's a liability, whether it's a asset, whether it's an inventory, whether it's receivable. So every fair value adjustment is going to create a taxable and deductible temporary difference, depending it's a gain or loss. Now, guys, we know in piecemeal acquisition, what we usually do, we take consideration. So what we usually do is we take consideration paid by parent. So consideration paid. We'll take what we paid today at the date of acquisition. So goodwill is being calculated at the date of acquisition. The first point is goodwill is being calculated at the date of acquisition. So we need to calculate goodwill on 1st April 2006. So every value should be every value that you are going to use in goodwill calculation should be at 1st April 2006, and majority value should be at fair value, means all the value should be at fair value in this question. NCA is being measured at proportionated share. So what we need to do is consideration paid. We have paid 18%. We have paid consideration for 18%. So we have paid consideration for 18%, guys. Right now on 1st April. So what we need to do is we need to take, if there is any fair investment, previously held investment, so we need to take fair value of previous investment. So this is piecemeal acquisition. If there is any previous investment in the same company, you have to take the fair value of previous investment, obviously at 1st April X6. Then we will write NCA. NCA could be at proportionated share. NCA could be at fair value. So here NCA is at proportionated share. So we will calculate this proportionated share. And then we have fair value of subsidiary net assets at acquisition. Fair value of subsidiary net assets at acquisition. By the way, we have fair value of subsidiary net assets at acquisition. We have 397.4. 7.6. So this is the net assets. Here we just calculated net assets 394.97.6. Now you need to calculate consideration paid. You need to find the consideration paid, fair value of previous investment. Proportionated share is very simple. We can easily calculate proportionated share. So how can we calculate proportionated share? Look, proportionated share of net assets. So you can take net assets, which is 397.6, and apply proportionated share. What is the percentage of NCI? So we are assuming we have acquired control. Previously, we were 30%. Previously, we were 30%. Now we acquired another 18%, and we are saying we have control. So it means NCI would be 52%. So we need to apply a 52% NCI. That would be the proportionated value of NCI. And this amount would be 206.8. So this is the value. Now, guys, what is next? So this is something that you can pick from the previous exhibit. Look, the consideration, look, this is 18% required. The consideration for a further 18% was 66 million. This is 66 million. And the fair value of the original 30% investment is 127. So guys, 127 and 66. So these are the values that we'll be using for goodwill calculation. So here is the value. Previous 30% investment has a fair value of 127, and currently we are paying 66. So it means we have a goodwill at acquisition at 1st April X6. So we have a goodwill of, yes guys, what is the value of goodwill? 2.2. So we have a goodwill of 2.2 million. So this is goodwill, guys, 2.2. So this was again a part for this, but again, now there is another step that you need to perform, is that we need to calculate profit or loss on previous investment. So there is the profit or loss on previous investment. So profit or loss on previous investment. So we know we have to take an assumption. There is always an assumption that we have sold this investment and we have reacquired this at fair value. Anyhow, we need to book so we have fair value of previous investment that we used in goodwill calculation is 127. We have calculated the carrying value of investment in associate in previous investment, carrying value of associate. So we are assuming that we have sold the associate and we reacquired it at fair value. So carrying value of associate is something that we have calculated in previous part, and this is the carrying value 118.6. This is the carrying value, guys. So we will pick this carrying value and we will write here 118.6. What was the value, guys? 118.6. So we have a profit of 8.4. Yes. So 8.4 is a profit. It will be charged to P&L. And we know the remaining portion that we have adjusted a revaluation gain here. We need to transfer that revaluation gain to retained earnings. So this was the part, guys. So please, if you have any question now, you can ask the question. If there is any question, so please ask question. Otherwise, we are done with this part. Question 1, this was a question 1 from December 2021 attempt. Is there any question, guys? Okay, brilliant. So what we need to do now, Okay, guys. Someone asked me, is there any deferred tax on this profit? Someone asked me, is there any deferred tax on this profit? On this profit, guys, this 8.4 million. No, guys, it will be taxable already in P&L. We are assuming it is disposed, so no deferred tax. Then now, guys, let's move towards another question. Yes, unrealized profit will create. Someone asked me, would there be any deferred taxation on unrealized profits to subsidiary? Yes, there would be deductible temporary difference. So now what we need to do is, so the next part of the question is ACCA practice to pass session, question 2, guys. Okay, someone is saying me, will you show how to write a theoretical form in exam, like how to link these calculations with our answer? Yes, I can show that. But just first, let me solve this question, and then we will be doing that, okay? In last maybe 10 to 15 minutes, okay? So we need some time to solve this question. I just want to complete this question, guys. Okay, so this is question 2, guys. One of the reasons of not completing the exam is, sir, this is something important. Sir, majority of you guys will be comfortable in question 1. Majority of you guys will be comfortable in question 1. As we know, in SBR, we have question 1, we have question 2, then we have question 3, and we have question 4. So usually candidates are confident about question 1 because it has some calculations, it has consolidation topics, related topics, and usually candidates prepare consolidation in a better way than other standards. So one of the reasons that you would be unable to complete the exam is that you complete question 1 in around 1.5 hour, means 90 minutes. You are completing it in 80 minutes. So if you are completing question 1 in 1.5 hour, then you can't complete your question 2, question 3, question 4 in remaining 1.5 hour. So the advice related to question 1 is that please don't put too much time on question 1. Just try to complete question 1 on time so that you can solve that so that you can complete the whole exam. So listen carefully right now. So it is my advice. Obviously, if you think it will work for you, then you should adopt this. Otherwise, you can start by your own way. So my opinion is that you should start from question 2. So the paper should start from question 2. It would be a 20 marks question. You will be comfortable with 7 to 9 marks of ethics. You will be comfortable. Maybe there is some IFRS that you are not comfortable with, but maybe there is such a certain IFRS treatment that you are not comfortable with, but there would be a 7 to 9 marks for ethics and you will be comfortable and you will easily get these 7 to 9 marks. So I would say that start from question 2, complete this question on time, and then move towards question 3, 4, or question 1. So the tip is, if you start from question 1, so please don't put your 80 to 90 minutes on question 1. Just try to complete this. It would be a 30 marks question, and you should complete this. If you should multiply this with 1.8, and you should complete this. You can multiply this with 1.95, but actually the 15 minutes, usually the first 15 minutes is something that you usually waste in watching what is in question 1 and what is in question 2. You just want to go through the all paper in just 15 minutes. So usually candidates wasted their 10 to 15 minutes to understand what is in the exams, and then they start. So I would say just try to keep in mind that you have 1.8 minutes per mark, and try to complete this question in time, and then you should be moving towards other questions, and at the end you will be able to pass to complete the exam. So this is my observation. I'm telling you, it will take time. So just try to start question paper form question 2. Okay. Now, guys, we're moving towards question 2. In question 2, there would be an ethics and IFRS section. I requested you guys to watch the video. I shared even in the WhatsApp group as well, to watch a video from September 21 practice to pass session. In that video, I have solved around 2 to 3 questions of question 2 type questions, in which we discussed various aspects. But I need to revise some topics here. So let's understand what are the topics that we need to revise to solve these questions. The first thing that we need to revise is other comprehensive income items, specifically IS 21 foreign subsidiary. Then the other thing that we need to revise is ethical principles and threats to ethics. I will quickly revise this, and I urge everyone, I request everyone to watch the video from practice to pass session from September 2021. So in that video, I have discussed this concept in detail. I have already shared that video in the group. I will share it again in the group. So please, you have to watch those videos as well. Now, on the other hand, we have to revise IFRS 15, IS 38, and then in 38, we have to revise research and development costs. So what we are going to do is, I have already shared a link of that video, so please follow that video, okay? Yeah, basically it was day 1 for question 2. It was day 1. Okay, guys, now let's understand some topics, and then we will be solving the questions, guys. Guys, as we know, in statement of comprehensive income, we have 2 items, 2 basically areas. The first area in statement of comprehensive income is profit and loss account, and the other area is other comprehensive income. In P&L, we write sales, cost of sale, GP, then we have gross profit, then we have other incomes, admin expenses, finance cost, profit before tax, and ultimately at the end, we have profit after tax in P&L. The other comprehensive income is the area that we need to divide further into 2 line items, into 2 further categories. So other comprehensive income items can be classified as, can be categorized into 2 categories. Some are recycled to P&L at some point of time. You are writing these items in other comprehensive income. You are writing every year, maybe after some years, you are writing another comprehensive income. But in some point of time, you have to reclassify these items to P&L. We call it recycle. So sometimes you have to recycle this into P&L. So you have to recycle to P&L. On the other hand, there are certain items that are not reclassified to P&L. Rather, they will be transferred towards retained earnings within statement of changes in equity, within statement of changes in equity, or you can say that they will not be recycled at all. Within statement of changes in equity, you can transfer from one head to another head, but you can't take them back to P&L. So what are these items, guys? The first item is OC items that can be recycled to P&L is foreign exchange gain or loss arising on translation of foreign statements of foreign subsidiary, which is IAS 21. When do we will do that? Obviously at disposal date. When a foreign subsidiary will be disposed, so at disposal date, what you need to do, you have to recycle all the amount of gain or loss towards P&L. So at disposal date, you have to recycle. So you have to write, when they arise, you have to write in OCI, you have to write in OCI, you have to write this on OCI, but at disposal date, you will recycle. Then we have effective portion of gain or losses on hedge instruments in a cash flow hedge, IFRS 9 cash flow hedge. We have two types of gains or losses on hedge instruments, effective, ineffective. Effective portion will be a part of OCI, but ultimately it will be recycled towards P&L. When it will be recycled, when hedge item will be charged to P&L. When hedge item will be charged to P&L. At that time, you need to recycle, will be charged to P&L. There is another way as well. So hedge item will be charged to P&L. When hedge item will be recognized and it will be charged to P&L, you need to recycle this towards P&L as well. Then guys, we have fair value through OCI, debt investment in IFRS 9. We have fair value through OCI, debt investment. This is important that this is debt investment. So what we need to do, the debt investment gain loss ultimately will be recycled towards P&L when at disposal date. So this will also be eliminated at disposal date. So now guys, what is next? So OC items that cannot be recycled into P&L are changes in revaluation surplus, IAS 16 and 38. They can be transferred to retained earning. They cannot be recycled back to P&L. Then we have actuarial gains or losses on defined benefit plans. The new name of actuarial gain losses is remeasurement gain and losses. They cannot be recycled to P&L. So remeasurement gain losses in IAS 19. Then we have gain losses on investment in equity instruments at fair value through OCI. So this is important. If we have fair value through OCI equity investment, we will take the gain and losses of these investments in OCI, but they cannot be recycled to P&L. But debt investments, gain losses will be recycled. Then we have the liabilities in IFRS 5, IFRS 9. Sometimes we designate liabilities at fair value through P&L and changes in fair value that belongs to our own credit risk will be charged to OCI. That will not be recycled to P&L back, guys. So these are the items that you need to keep in mind. These items are OCI items. When they arise, they will be charged to OCI. But at some point of time in future, they will be recycled. And these are the items that will not be recycled. They can be transferred within statement of changes in equity, obviously at their disposal date within statement of changes in equity, but you can't recycle towards P&L. So this is important. Then we have basic principles of ethics. We know there should be an integrity, objectivity, professional behavior, confidentiality, and professional competence and due care. So I'm not talking about these things to just save time, because I have already shared video of September 2021. So please watch that video. In that video, I have discussed these principles in detail. But there are certain threats like self-interest, means some financial or other interest. Are there familiarity threat? Then we intimidation threat. Then we have self-review, advocacy threats. So these are the threats due to which usually people are motivated to do the unethical activity. So to involve in unethical activity, usually they are motivated due to these threats. You have to identify these threats from the question, otherwise you can't get the two professional marks. So two professional marks are available. These two professional marks are available, and one professional mark will be available if you will link these threats from the question. You will pick the threads from question and you will link with your answer, with your answer within your answer with these basic principles, then you'll get one mark. And what is for the extra 1 mark, I will talk about that. These self-interest are, guys, look, common examples in the questions are self-interest, intimidation threat, familiarity threat, and advocacy threats are given. Bonus related, bonus based on profits are ratios, promotion, job security, loan covenants. These are certain self-interest due to which they are motivated to do the manipulation in financials. They are motivated to indulge themselves in unethical activities. Then familiarity threat is that your intimidation threat is that you are new to the company, your boss has ordered you to do an unethical activity. Then familiarity threat is there. Advocacy threat is if you are representing the company somewhere like in litigation, or you're applying for a loan, and obviously you want to get to you want to get the loan, and you will try to manipulate the financial so that you can easily get the loan. Now guys, we are moving straight to the question. So what is this question we need to understand? And there, this is 9 marks question, and actually 2 marks extra is available for professional marks, and we will be talking about how we can get these professional marks. Look, so guys, this is professional marks. Two professional, it means 8 plus 3, 11 marks are available for this part of the question. So let's understand, guys, what is the requirement. First, the first requirement is the year end is 31st December 2007. Look, this is year ending. Okay. So discuss the appropriateness of Mr. Ravi's accounting treatment of foreign exchange gains on the retranslation of foreign subsidiary which is held for sale. So it is not yet sold, it is held for sale, but they are asking you whether that treatment is appropriate or not. The marks are 3 marks are available. So you need to write it just for 3 marks. Remember this point. So let's understand what was is treatment and what we need to do. So listen carefully, guys. The first paragraph, I didn't see any treatment, accounting treatment. Then I didn't see any accounting treatment. This is the paragraph, guys. So what we need to do, let's understand to solve the part A. So it means part A belongs to this paragraph. It is related to this paragraph. Now what is next? Let's understand. Second requirement is discuss any ethical issues raised by Ms. Malgan's action regarding her management of Mr. Ravi. So ethical issues raised by Mr. Malgan's actions regarding her management of Mr. Ravi. So we need to discuss ethical issues regarding the management, how she is managing Mr. Ravi. Obviously, we have some ethical issues with in respect of Mr. Ravi, and obviously we will have some ethical issues with in respect of Miss Malgan. So let's understand, guys, what we need to do. So let me solve this question. So listen carefully, guys. On 1st October 2007, our finance director, Miss Malgan, a financial accountant, recruited Mr. Ravi as an ACCA student accountant on a temporary employment contract, which can be terminated by either party without reason. Do you see any threat in this, guys? Do you see any threat in these lines, guys? termination without reason. It means it can be terminated. So Miss Malgan can terminate Mr. Ravi at any time. It means there are two things here. It means Mr. Ravi will always be intimidated. And there will always be a self-interest for Mr. Ravi. He will always try to please Miss Malgan because she can terminate him at any time. So temporary employment contract, it can be terminated without any reason. So it means there is a constant pressure due to the nature of contract. So there is a constant pressure, guys, on Mr. Ravi. Mr. Ravi has found it difficult to find employment and therefore accepted the risk attached to the employment contract. So Mr. Circumstances of Mr. Ravi is he is finding up he has found it difficult to find employment. It means he is under immense pressure due to the the situation that it is difficult for him to find the employment. Again, so he's under a constant threat because he's unable to find another job. Then, guys, however, the jurisdiction has laws which protect employees from termination due to discrimination. Mr. Ravi has been told by Ms. Malgan that there has been a global slowdown in business and that the biggest uncertainty is customer demand. She has therefore impressed upon Mr. Ravi that the company's profitability targets are based on achieving 30% higher net profits than the nearest competitor. So their performance are being monitored by profit targets, and the condition is that you have to be higher. You should be earning 30% higher profits than your competitors. So Mr. Malgan is partly remunerated through profit related bonuses. So guys, just do let me know, is there any threat? Yes. Their performance is being monitored by profit values, profits, and profits are declining. If the profits are declining, it means they are motivated to increase profits. They want to increase profits because profits are declining constantly. Then again, their performance is being monitored by the profits, so they don't want every employee don't want that their performance should should not be at par. So, and the most important thing is there is self-interest as well. Ms. Malgan is partly remunerated through profit related pay. So these are the things that you need to write, that why they are motivated to go for unethical accounting, for unethical activity. So you need to tell these things. On the other hand, he's an ACCA student. So it means there would be a problem of knowledge as well. So he's new to the company. He is in a constant pressure due to the nature of a contract. Ms. Malgan is motivated to get the bonus and to meet the targets. Now, Ms. Malgan has been under significant pressure from the board of directors to meet performance targets that would normally prepare the year-end financial statements. However, for the current year end, she has delegated this task to Ravi. So Ravi, who is an ACCA student, so Ms. Malgan has, which is the financial accountant, and she has a knowledge of IFRS. She has delegated to finalize the financial statements to Mr. Ravi, who is just a student. So this is another problem, that maybe Mr. Ravi don't have sufficient knowledge, experience to finalize the financial statement. One thing, yes, there would be a problem of lack of competence. So there is a problem at the end of Mr. Ravi, but we can't say that there is a lack of competence, because the competence expected from a student is not obviously to the level that actually Ms. Malgan has. So we don't expect that an ACCA student should be competent enough to finalize the financial statements. And he's just 3 months old in a company, and he's doing this first time. So there is another issue as well. Ms. Malgan is delegating this task to a person who is just an ACCA student. So there is a problem at the end of Ms. Malgan as well. Mr. Ravi has included. So I just want you guys to read this paragraph and just to conclude whether the treatment by Mr. Ravi is acceptable under ICE 21 or not. So I'm waiting, guys. So you just have 2 minutes, 1 minute to read this. So I'm waiting. Okay, guys. Now, Mr. Ravi has included in profit and loss the foreign exchange gains arising on the retranslation of foreign subsidiary which is held for sale. So they can't be charged to P&L, guys. This is an OCI item and should be charged to OCI. Mr. Ravi has emailed Ms. Malgan informing her of the accounting treatment. Although Ms. Malgan is an expert in IFRS standard, she did not comment on this incorrect accounting treatment of the foreign exchange gain. So the treatment is wrong. Ms. Malgan, no. So there is a problem of integrity at his end. Professional behavior is being compromised. Integrity, objectivity is being compromised. Why? Because she is an expert in IFRS, but she didn't comment. Now, guys, one professional mark is to link the threads with threads, to link the threads with threads, to pick these threads from the question and to write in your answer. And the one professional mark will be available. Listen carefully. One professional mark will be available if you link this treatment with profit and loss, and in SOFP if it has some impact on SOFP as well. And why they are doing this? Why they are doing this? So if you link your accounting treatment in the question with the financial statements, the impact of those accounting treatments on the financial statements, then you will get this one professional mark as well. So the one professional mark would be that picking the threats to the ethical principles and relating them to the basic principles, and the other one is just to describe the accounting treatment, that treatment is wrong or true, and what is the impact of that on the financial statements, and to link that why they are doing this. So can you tell me that why Ms. Malgan and Mr. Ravi is doing this? Mr. Ravi is an ACCA student. Maybe he is not aware of the fact that this should be charged to OCI. But why Ms. Malgan is doing this? Why Ms. Malgan is doing this? Why she is silent, although she know that? So please, guys, do let me know why. Why? Which self-interest? You need to be specific. Yes, there is a self-interest. Yes, the first one is to get the bonus. Yes, you are right. Yes, to manipulate profits profits as its performance related targets. So they just want to meet the performance targets and they want to get the bonus. So that's why they are doing this. So this is how you are going to relate. Okay, that why they are doing this. Look, these are the gains. If this would have been losses, then obviously Miss Malgan would have commented that no, this should not be charged to OCI. This should not be charged to PNL. It should be charged to OCI. I hope everyone is clear, guys. After the financial statement has been published, Ms. Malgan disciplined Ms. Ravi for incorrect accounting treatment for the foreign exchange gains. So after the financial statements has been published, Ms. Malgan called Mr. Ravi and said you did the wrong treatment. This should not happen again. So he disciplined Mr. Ravi for an incorrect accounting treatment of the foreign exchange gains. However, despite this, she is prepared to make his employment contract permanent. So it means there is a lack of integrity at the end of Ms. Malgan, and we know why she is doing this. I hope everyone is clear. Now, guys, we are moving towards part B of this question. So let's move towards the next part. Is that okay, guys? Please watch the videos of practice to pass session, the video 1 and partially video 2. So you can watch video 1, day 1, from practice to pass session for question 2, and half of day 1, day 2, half of day 2, and you can watch day 5 as well, because in day 5 I have solved a consolidation question. So this is day 5. So you can watch these 3 videos, guys. Now what is next? In this question, guys, in part B of this question, there was an issue of revenue, there was an issue of transaction price, and there was an issue of intangible assets. So what we need to do, we will quickly revise this. Yes, I will share the link of those videos in the WhatsApp group. I will share that, okay? I will share. Now listen carefully, guys. Revenue arising in the course of entities' ordinary activities. What is revenue, guys? Revenue is something that arises from ordinary activities. From ordinary activities. So it means if you are generating income from ordinary activities, that would be revenue. But non-ordinary activities cannot be classified as revenue. Non-ordinary activities cannot be a revenue. So if you have income from non-ordinary activities, it means this income can be classified as other income. You can write it as other income, but it cannot be a part of revenue. You can say that these are the gain losses, but you can't say that this is the revenue. The best example is when you sell a non-current asset. So selling a non-current asset and earning some profit or loss, non-current asset. Like in this example, we have sold an intangible asset, and that cannot be classified as revenue because selling a non-current asset is a non-ordinary activity. So the first point that we need to apply in this question would be the definition of revenue. Then, guys, we have transaction price. Transaction price in IFRS 15 is step 3. Determining a transaction price is step. And they define transaction price is, it is an amount of consideration. It is an amount of consideration. The most important word is that entity expects to be entitled in exchange of transferring promised goods or services. Excluding amounts collected on behalf of third parties is, it means if you have collected tax, VAT collected on behalf of other parties, on behalf of other parties. So VAT collected on behalf of other parties, that can't be a part of revenue because we have collected on behalf of third party. But right now my focus is entity expects. So the amount of consideration to which entity expects to be entitled, what entity is expecting, that would be a part of revenue. Okay. So we need to make 4 adjustments in transaction price, guys. At step 3, we need to make 4 adjustments. The first adjustment is time value of money. In step 3, the first adjustment is time value of money. If time value of money is significant, it means you are selling goods now and you will receive in future, so you need to take present value. Okay, this has already been covered in the previous practice to pass session. Then, guys, the second thing would be after time value money is non-cash consideration, which means barter transactions. What does it mean? If you are exchanging goods, you are selling goods in exchange of shares, you are selling goods in exchange of goods, you are selling shares in exchange of services. So you are not getting cash in exchange of sales, you are getting non-cash consideration. So whenever there is a non-cash consideration, we say that revenue should be fair value of consideration received, fair value of goods services received. So this is not relevant point here in this question. The last thing, the third thing is consideration payable to customer. If you are paying consideration to customer, usually customers pay us, but if we are paying to the customer, then we will see whether we are buying some goods from the customer or not. If we are buying, then obviously we are paying in exchange of those buyings, in exchange of those purchases. But if we are not buying anything and still we are paying them, it means our revenue should reduce by the amount we have paid. And the last thing is variable consideration, that is a little relevant here. Variable consideration is a consideration that we don't know whether we will get this amount or not. Maybe this amount is contingent on certain thing. So maybe there is an uncertainty at the end of other things. The examples are very simple: discounts, rebates, refunds, credits, price concessions, incentives, promise bonuses, penalties, or other similar items. We don't know whether we have sold goods for 500 and we have offered 10% discount if the customer pays us in maybe in 10 days. If we have offered that if you pay us in 10 days, we will allow a 10% discount. It means we will receive 90%. So now we may receive 90%, maybe we receive 90% along with 10%. Maybe we receive, if the customer availed discount, then we will only receive 90%. If we didn't avail the discount, then it means we will receive extra 10% as well. So this 10% is a variable consideration. So variable consideration will be a part of revenue, if it is highly probable. If it is highly probable that you will get this amount, then you can take this amount as a part of revenue. But if you are uncertain, then you cannot book a revenue. You cannot book a revenue. You cannot book a revenue of amount that is variable, of a consideration that is variable. If it means, if we are not sure whether the customer will receive a discount or not, it means we cannot take this 10% revenue. We'll only take 90% because we are not sure. But if we are sure that this customer is not going to take discount, he always pays late, he will not take discount, then we can take this 10% as a revenue as well. Means 90% we need to book, and then we can book extra 10%. So we call it reversal test as well. Reversal test is if you are going to book a revenue, but you are unsure. So you can't book a revenue because in a near future, you have to reverse this. So if you're thinking that maybe I have to reverse this revenue, although I'm recognizing revenue today, but maybe I have to reverse this revenue. I have to eliminate this revenue in near future. So you would say that no, you can't book the revenue. We call it reversal test. The most important line here is the these last lines. Sales or usage-based royalty. Sales are usage-based royalty revenue arising from licenses of intellectual property. Such revenue is recognized only when the underlying sales or usage occur. So this is the conservative approach that they use for royalty income. If you have given a license to someone of your intellectual property, on the basis of usage and sales, you have to get you will get some amount. Then you have to book a revenue only when that sales or usage has occurred. What does it mean? So this is important, guys. This is important for your exam. So what does it mean if I have copyrights? I have written a book. I have a copyrights of that book. Now I have given copyrights to certain person, to certain company. Now that company, and the contract is, whenever they will sell one unit, they will pay me something. So when I'm going to book a revenue, so I will wait at year end, I will see how many units they have sold. If they have sold 20 units, then I will book revenue of 20 units. Obviously, the royalty income that I'm going to receive on those 20 units. So the amount, the revenue, the goods that has been sold, that has been used. So if the usage based or revenue based, royalty is going to be received. This is going to be an income when that thing happened. Otherwise, we are not going to book the revenue. So let's understand what is in step two. I have discussed this step two in detail again in the last practice to pass sessions. So I'm not going into a further detail. Actually, I picked this slide from the last practice to pass session. And obviously, I'm going to share the videos as well. Now, guys, we are going to solve a question two, September, December exam. This is a question for 5 marks, guys. So let's understand what is in this 5 marks. Discuss how the granting sale of a license to K company should be counted for by agency company on 1st Jan 2007. So they are asking you how discuss how this sale should be accounted for. Okay, so let's understand. On 1st Jan 2007, agency company granted, and the word is sold, Kokila company a license with no end date to sell a headache product head on in South America. So what they are doing, they have granted a license that they actually give a permission that they to sell a product in the South America. To be basically, it's a medicine for headache. Agency company has retained the right to sell head on in the rest of the world. So the remaining license belongs to us. So we can sell everywhere in the world except South America. So we have given license. The South American market's relative value compared to the rest of the world is 20%. So it means I'm selling a license. I'm selling a license. License is my non-current asset, intangible asset. I'm selling my intangible asset. And the portion that I'm selling is actually 20%. The manufacturing process used to produce head-on is not specialized, and several other entities could also manufacture it for Coca-Cola company. So guys, this is not complex. This is not specialized. It means anyone can produce this medicine. This is not something that we only. This is not something that only that this is not something that we sell, that we only that we produce only, or we sell only. This can be easily produced by anyone. Now, why this line is mentioned, I'm going to highlight this area as well. Kokila company will purchase head-on directly from agency company at a cost plus 50%. The product has been sold for many years. So listen carefully, guys. In this transaction, actually agency company is selling is actually making a contract of two items. Agency is selling, look, One thing they are selling is the license, and the other thing is they are selling medicine. Medicine will be delivered over the years, every year it will be delivered every year. And the license to sell in South America with no ending date has been sold. So license has been sold. So the medicine selling is an ordinary activity of agency selling, agency. So it will be a part of revenue, but obviously revenue can only be recognized when performance obligation satisfied, when PO satisfied. So, and the license has already been sold, but partially. We didn't sold the entire license. We retained 80%. So partial selling a partial disposal है. So this is partial selling or partial disposal. So what we need to do, we need to de-recognize 20% of license. Why 20% of license? Because 20% license is not going to give us any benefit. No future economic benefits expected. No future economic benefits expected. So we can say that agency is selling two contracts separately. We can say that this is a separate PO. This is a separate PO because they are not interrelated. Where actually this is written that they are not interrelated, this is written head-on is not a specialized thing. The manufacturing process to produce head-on is not specialized, and several other entities could also manufacture. It means this is the license and the medicine is not interrelated. They are independently, they can be sold independently. They can buy medicine from anywhere. So there are two POs. The one is revenue, obviously will book the revenue when the POs are satisfied, but the license, you need to de-recognize 20% license, and you cannot say that this is revenue. This will be a profit or loss on disposal, and it will be a part of other income. Now, on 1st Jan 2007, Coquilla company made up upfront payment for 15 million and will make an additional payment of 3 million when South American sales exceeds 35 million. This is variable consideration. Variable consideration will be recognized if you are virtually certain. Otherwise, it will be sold. It will be recognized when the sales will exceed 35 million. So basically, you can say that this is the sale based. You can say this is a sales based royalty. If the sales will exceed 5 million, we will get extra 3 million. So this revenue will be booked when the sales will increase, will exceed from 35 million. Agency company had correctly capitalized development cost for add-on is an intangible asset at a carrying value of 30 million. Now listen carefully. He's saying agency company had correctly capitalized development cost, had correctly capitalized development cost for add-on. It means it was an intangible asset, 30 million, and you are selling an intangible asset because he's saying correctly capitalized development cost for add-on as an intangible asset. What we need to do, we can write a journal entry here that we need to de-recognize an intangible asset, probably 20%. So we need to book and to eliminate intangible asset only 20%. So this will give you a carrying value 6. The cash would be 15. So you can say that you need to recognize profit, the balancing amount will be profit or loss. But if this upfront payment has some, because we are actually doing a contract, you are going to sell at cost plus 50%. You are actually selling two POs. So maybe this 15 million includes, some amount of related to revenue and some amount related to medicine. So need to split. Otherwise, the profit a loss on disposal would be 9. So this is the part, guys. I hope everyone is clear. So if you have any questions, you can write the question now. Actually, Komal, I'm watching your question, so don't worry. But you can't watch the questions of others, okay? Yes, you can do that. Yes, you can. You should write the 5 points, but you need to cover these points, okay? Guys, one more note is that if you read the examiner's answer, that is very extensive. You don't need to write the whole answer, guys. You just need to reproduce 60 to 70%. That's it. You just need to produce 60 to 70%, and that's it. This is not revenue. This would be a profit on disposal. This can't be this profit a part of revenue. If you are considering 15 million upfront amount is belongs to the sale of license, then this will not be a part of revenue. So, okay, you just need to write 15 to 15 to, so you just need to write 16 to 70% of your answers. Okay, now the last part is related to intangible assets. In intangible assets, we know that the recognition criteria should be met. The recognition criteria is it should meet the definition of intangible asset, and then inflow of economic benefit should be probable, and the cost can be measured reliably. So the cost can be measured reliably, and inflow of economic benefit should be probable. And there are certain additional criteria for the development cost as well. And the criteria is that the project should be technically feasible, you should have intention to complete, resources should be available to complete the project, inflow of economic benefits are probable, and cost reliably measurable, and you must have an ability to use or sell. So economic benefit should be probable, guys. If no economic benefits are probable, then obviously you can't capitalize the development cost. You must have ability to get benefit either through the use of that asset that you are developing internally, or you can sell it to the output to the market outside. But on the other hand, what is important, you have to prove, if you want to prove that I want to sell this and I'll get the benefit, then you have to prove that there is a market available where you can get the benefit. Now, there was a question in WhatsApp group that what was that question? Let me address the answer here. The question was, guys, someone asked that if there is a development cost, we know research cost will be charged to P&L. Research cost will always be charged to P&L. But if there is a development cost and we came to know that the criteria is met. So if criteria not met, it will be charged to P&L. No criteria met, it will be charged to P&L. If criteria met, then it will be capitalized. So it will be capitalized. If that criteria met, capitalized. Otherwise, criteria not met, charged to P&L. Now, guys, so here, accountant said that the criteria is met, so you capitalize this asset. Now here, you came to know that the criteria is not met. What to do? So it should be a prospective treatment. No retrospective adjustment required. You should charge this to P&L. You should charge this to P&L, guys. So we will charge this to profit and loss in this current year. So all the asset capitalized in the previous year when the criteria was met, but now the criteria not met. So prospectively, you need to charge this to P&L. And later on in the next year, if criteria met, you cannot capitalize this previously charged cost to P&L. This is the normal treatment. But if there is an error, there was an error. Accountant thought that this should be capitalized and they capitalized it, and it was wrongly capitalized. Actually, criteria was not there. Actually, criteria was not met, but accountant thought that the criteria is there. Criteria has already met. So now you came to know that this error, you just discovered that this was an error. Now errors will always be adjusted retrospectively. So if you came to know that there was an error at the time of capitalization, then obviously you need to adjust it retrospectively. Otherwise, you can adjust it prospective. First criteria met, capitalized, then you find that criteria is not there. You were right when the criteria met. Now you are not confident about the project, then you have to charge it P&L and it will be prospective. Now the question here is, you have to check whether development cost criteria is there or not. So let's understand, guys. Agency company is developing a biosimilar product for the treatment of particular medical condition. A biosimilar product is one which is highly similar to another, which has already been given regulatory approval. So guys, it means we will get regulatory approval. So if we'll get regulatory approval, it means the medicine will produce benefits. We will be able to get benefits. The existing approved products patent is expiring and agency company has applied to the government for regulatory approval of its new product. The submission includes an analysis which compares QDICs to agency companies' proposed products in order to demonstrate biosimilarity. The government has reviewed the analysis and allowed agency company to undertake initial medical trials. So they have given approval and they allowed us to undertake initial medical trials. It means resources are there. We have intention to complete. This project is technically feasible. We will produce this product. Now the point is whether we can get benefit or not. It apparently feels that we can complete the project. Oh, now listen carefully. Agency company feels that the trials are going well. So things are going well. So we are confident. So we can say the criteria has met. The product is used in the treatment of a very specific condition, which affect only small group of people. And agency company has decided to develop this product for reputational reasons. Person using the product will only pay a notional amount for the product if it is proven to be effective. What do you think, guys? Will you get the benefits out of this development project or not? Do you have ability to get benefit in future or not? Please tell me. Few people are there, they will pay very notional amount, a very little amount, and you are actually producing this for reputational reasons. So you just want to get the repute that this company is preparing. So it appears, guys, that the criteria has not yet met. So the cost should be charged to P&L rather than capitalization. So this was the question 2, guys, from recent attempt. This was all for today. Now we have few minutes left, just 3 minutes left. So, and we have why we expensed. Someone asked me why we expensed. Because criteria is not there. Inflow of economic benefits is not probable. Inflow of economic benefit is not probable. Inflow of economic benefit is not probable. That's why. Now, guys, even if the trial goes well, because we are not expecting any inflow of economic benefits from this product, because we are producing it for reputational reasons, and the customer is going to pay a very little amount against these products. So yes, we should book a this cost in P&L. Okay, guys, I'm saying again and again that this is not important that this should be capitalized or not. The important is how do you construct your answer. You need to construct that these are the reasons why I'm saying this should not be capitalized. So you need to prove these things from the question. I hope everyone is clear. That's it for today, guys. If you have any question, please ask questions in WhatsApp group. I'm going to message to all those who have already texted me. I'm sharing my number again. You can text me, you can WhatsApp me by just saying that please add me to the group. So this is my number. You can WhatsApp me here. So if you have any question, please ask question in WhatsApp group. That's it for today. See you tomorrow. Tomorrow we will be solving question 3 and question 4 style of questions. So tomorrow we will be solving these types of questions.